Hello, everybody, and welcome into VRIC Media, your most trusted voice in metals and mining. My name is Jesse Day, and today is January 13th, 2026. We are, of course, bringing the VRIC to you with our series of expert online panels. And today I'm joined by Patrick Karim and Kevin Wadsworth, the founders of NorthstarBadCharts.com, where they cover chart-defined macroeconomics and trading. We're going to be putting their expertise into action today to discuss gold, silver, uranium, and more. Gentlemen, it is an honor to have you both back on the program.
Hey, Jesse.
Hi, Jesse. What a time to be alive. Thanks for having us
Yes,
on.
what a time to be alive. And I think we need to start with the silver market. The metal's been on an absolute rampage, recently surging to new all-time highs once again, sitting at around $87 as of the time of this recording. Now, there's a lot of euphoria on social media, obviously, and that's why I love having you guys on the show, because sometimes you present the reality as the charts tell you, and you don't usually buy into the narrative. But the calls for triple-digit silver are obviously growing louder. A lot of people are proclaiming that silver's time has come. This is it. We're in a new paradigm when it comes to the silver market. Price suppression is over. Silver's finally breaking free. You know, on the upper end, I've heard $1,000 an ounce. On the conservative end now, people are saying $100 an ounce. So maybe you could help bring some clarity to this situation. Is some caution warranted at these levels, or do you see more upside ahead for silver? And Patrick, I'll start with you.
Yeah. Well, yes. Yeah, the narratives they're fun, right? They fuel you see your net asset value rise, and then you hear more bullish news, and then you get even more greedy. And look, we've had the same thing back in 2020. Who remembers silver squeeze? That euphoria, First Majestic gapped up at the open. They couldn't, LBMA couldn't deliver whatever. It was similar stories to maybe a lesser extent. We weren't talking as much about monetary reset back then. It was more silver squeeze. But you remember, like, the price creates the narrative. If the price would stay stagnant, all this talk there we're hearing today, whether it's true or not, we wouldn't really talk as much about it right now, because the price going up, it's justifying all the narratives you could ever have. It's like proof, it's this, I told you guys it was going to go up because of the narratives. But look, Kevin and I, we look at the charts, whether that's the specific narrative that drove out the price. But if we're honest with ourselves, there's a plethora of narratives. There's a plethora of market participants, and who cares at the end of the day what's happening, right? I know people, they want to do the reset, but look, I'll just show you the chart for that $100, guys. It's just a chart. Like I heard some targets like way back. I was tracking this chart. We're maybe in the 40s, even lower there. And it's a daily log scale chart for silver. And then I heard some targets about $100 before Q1 ends of 2026. And I said, okay, fine, but we're down here. So the slope for silver was one touch, two, three. It was slowly going upwards here. So I said, okay, as long as the price stays above that line, we have a shot at going higher. We will go higher. As long as the price stays above that line, we will go higher. It's mathematical, right? But then after that, we started getting these accelerations here. Oh, here's a strong acceleration, but it failed. Then we went sideways, and then a new acceleration went upwards. And that acceleration, that very steep acceleration, has held so far. We had a small dip here, but it keeps going up. So that moves the whole time scale. What I thought was going to be less likely when I originally had that line, because we didn't have those accelerations, it has become more likely because of the acceleration. And I'll just be super pragmatic about it. As long as that very steep line holds, then this is a time range to reach $100. It could be before February. It's like could happen in the next couple of weeks there. We could hit that $100 as long as we hold that line. So that's how you do it mathematically and objectively. As the price changes its acceleration, you have to adapt, right? You can't say, well, this is less likely anymore, $100 per Q1. No, look, objectively, this thing has been rocketing. So as long as that line holds up, everybody rejoice, money for everybody. It's all your favorite narratives are coming life. They're coming to life because there's no correction that could happen until that line is closed below. It's a clear skies ahead until that line closes. Once it closes, we close below that line, then we're going to have to start revising. Okay, what's happening here? Are we starting to get the closes on the weekly? Is that thing starting to cascade onto the monthly? But we're not there yet there.
And Kevin, what are your thoughts on the silver space? And could we experience a dramatic correction here? Is that a risk considering how far and how fast silver is rocketing? I know you guys look at charts, but people also like to talk about profit taking, how at some level, a lot of people who got into silver, at the $30 range are going to want to cash out. Do you think there is a risk of more of a drastic correction as opposed to perhaps a slow, steady one in your view?
Okay, well, this comes down to timeframes, doesn't it, Jesse? It depends whether
Yeah.
you're a stacker, whether you're an investor, or whether you're a shorter-term trader. I mean, you could be an investor with a shorter time frame. You could be an investor with a longer time horizon. It depends on your own time frame, your own goals, your own ambitions, what it is you're trying to achieve. Me personally, I'm a combination of long-term investor and shorter-term trader. What that means is that the evidence that we've been presenting for the last few years, which centers around gold and silver breaking into new bull eras versus the stock market, that is the long-term trend. That has now been confirmed. We've had a capital rotation process complete, which means that gold and silver have broken out versus a wide range of indices and assets. And that puts us in a situation like the early 2000s, the early 1970s, and the period around 1929, 1930. And we know what happened after each of those points in time when the evidence was also in place. Gold and silver went up by many hundreds or even more than 1,000%. Commodities, energy and oil followed along. Things like copper, for example, whilst the stock markets effectively went nowhere for over a decade. So we have the evidence to say that for those with a long time horizon who don't mind sitting through significant drawdowns that can take a year or more to play out, and indeed silver could fall 30% or more, if you don't mind sitting through that and you've got a long time frame confident about the long-term bull era, then that's fine. If you want to take profits, as you said, again, that depends a little bit on where you enter the market. If you're sitting on profits of, let's say, over 100%, possibly 150%, and you're seeing all of this kind of bullish narrative breaking out, and you're hearing people talking about silver more and more, it's telling you that we're nearing an important top. That's the kind of narrative way of knowing that you're nearing an important topping area. There are technical ways of doing that as well, by looking at, for example, how far we are from the moving averages, the long-term moving averages. And we've known for a while that we're getting quite historically stretched from those long-term moving averages. But as Pat said, even as a trader, you do not want to really exit until or unless price is breaking below your stop loss. And how you decide where your stop loss is entirely up to you. But you can be raising your stop loss as the price goes up. And for me personally, I probably wouldn't be won't be exiting positions on a large scale until or unless the price of silver breaks below some of those important support lines and trend lines that Pat was talking about. So whether you're trading or investing at the moment, you can continue to ride the trend. A sign of weakness, you can start lightening up on that. You can take profits when we hit upside targets. It all comes down to how you're playing this. But I think really for many people to avoid getting whipsawed around and avoid confusion, having some kind of core long-term position in a gold bull era makes a lot of sense. A little bit like it does with your 401k, having money in stock markets during a stock market bull era. As long as you've got some sort of broad exposure to the stock markets in that environment, then that's going to see you fine for multiple years. Well, now we're moving into the environment that favors commodities and precious metals. So having some sort of long-term core position in those makes a lot of sense.
Our project is right in the southeastern corner of Wyoming. In the space of 4 years, fully engineered, fully permitted.
The ASIC is what caught my eye, $937 per ounce.
110,000 ounces per annum. First year of production is the most impressive. 132,000 ounces of gold, 24 million pounds of copper. You really want these things front-end loaded like that. US Gold Corp is a near-term, low-cost gold producer in Wyoming. To learn more, go to usgoldcorp.com.
Yeah, great insights from both of you. Let's talk about gold for a moment here, also hitting new all-time highs recently. Although, of course, if we look at 2025 as a whole, it greatly underperformed silver, but has also been much less volatile along the way. How does gold's run differ from silver? And how do you see gold positioned here in 2026, Patrick?
So what I could show you for this is the gold to silver ratio. All right. Oh, cool. I have my drawings. Yay, rejoice. So this is a historical gold silver ratio, guys. I know a lot of people like to look at that. So in a healthy, in a bull market where when gold and silver are going up together, if this ratio is going down, that means it's full steam ahead. Silver is going up, but it's going up faster than gold, and that's great, right? That's just step one. And then after that, here we're at a support area. We went down through the 57. Now we're testing the 50 to 1 ratio. This is pretty much that congestion zone. Look, we might have a spike down below it, but it's starting to get in the frothy area for silver versus gold. At one point, you're gonna want silver to start slowing down and let gold appreciate versus silver, or else these huge spike downs, if it goes way too down where silver outperforms gold way too much, then that you see that at tops, but like bull market tops. We don't think we're at a bull market top at all in gold and silver, because gold's uptrending now versus the SPX. Silver has broken out versus the SPX, right? It's starting to trend upwards. Copper's starting to join the party. Eventually, we might have oil and soft commodities join the party. So you don't want a crazy spike down here in favor of silver versus gold. You don't want that end game one. What you want here is what we see at the beginning of those CREs, those capital rotation events, process and events. The initial spike down at the beginning of silver outperforming gold, but then there's a market sell-off. There's a recession. Gold sells off, silver sells off, but silver sells off more than gold. And then you got a reflation here on the turns. Here's the dot-com bubble. So gold's holding its value better than silver on the turn. And then when there's a recovery mode, once the markets bottom and start recovering, then silver starts outperforming gold once again. And this rockets downwards. Here we had the GFC. Silver takes a hit, gold takes a hit, but takes a hit less. It reflates the gold silver ratio. And then we had that final recovery in favor of the stock market, that final melt up of silver versus gold. And then we got the top in the precious metals. So right now for the game plan is we have these huge rounding tops that are leading just to the first wave down, but you're going to have to expect here a recovery for gold versus silver. Either, like I said, it's like a GFC type of event, .com type of event where silver gets sold, gold gets sold, stock market gets sold, but silver gets sold more than gold. Hence the ratio reflating, retesting a breakout line. Like this is like standard behavior there. People cannot expect this thing just to keep going down and down and down forever there. It's going to reflate eventually. So what's going to trigger that? And it's on that reflation. If it's accompanied with a stock market weakness and rollover, then we are truly into a new era, a capital rotation event era. And I'll just show you this bigger chart here I have pinned on my Twitter feed. This is the Dow Jones price and silver chart. Huge pattern here back in the 30s, in the 60s, the rollover of the stock market versus silver. Look at that. The analog of this, the fractal, is very close by. Here's the dot-com bubble. Here's the rollover. Stock market's not able to outperform silver for a long time now, showing the underlying weakness, just unlike the 60s when the stock market was not able to outperform silver, even if they were both going up nominally, price and fiat. That was step number one. And look at that. Look where we are now there. We are somewhere here. This is a quarterly chart, so we might be a little bit below now. Let's see where this closes. But if we bounce here, it could be a little like a reprieve for the stock market. But once that rolls over, then we got another 1970s type of era for silver. So whatever silver's doing now, Jesse, whatever gold's doing now, they'll do much, much better in the coming years, right? We're going to continue outperforming the stock market. If that line breaks down, it's just going to be those crazy targets. Your $300, $400, $500 silver. They're 100% on the table once we close down. And if your time frame is 10 years, I don't see why you're not going to get $10,000 gold, $15,000, $20,000 gold. It's the roadmap until the evidence shows us otherwise.
And Kevin, what are your thoughts? You mentioned,
Yeah.
Go ahead.
I answered something. I just went on a rant.
Yeah, but that's the exact type of rants we want to see. Kevin, you mentioned that we're in a new era, as Patrick has outlined as well, with precious metals outperforming the broad stock market. What does that look like for gold in your view moving forward? And are you of the same mind as Patrick that we're in a very long-term secular trend when it comes to this bull market?
Absolutely. I'm going to share my screen here and hopefully can confirm that you're seeing what I'm
Yeah,
seeing.
yeah.
This is my X feed as well, and pinned to the top of it, I've got a post that explains it very clearly in terms of what gold is doing at the moment. This is a capital rotation event that we're looking at coming towards us, and this is the capital rotation evidence that tells you that the event is highly likely to take place in the near future. So these boxes are gradually turning red over the last 2 or 3 years. So this is gold versus things like money supply, the US dollar index, CPI, PPI, currency in circulation. So all of these things are now in a bear market priced in gold. Equal weighted S&P, the New York Composite, the Dow Jones, the Wilshire, the Russell. And these last two boxes here, they were green until relatively recently. And I've been holding off coloring those in red just to make sure that they are breaking out above key long-term moving averages, above key resistance lines, and above certain points on our technical indicators. So I would say that they now meet the criteria to say that gold, or rather the S&P, is in a bear market environment versus gold, and the same with the NASDAQ, it's in a bear market environment versus gold. So this has only happened 3 previous times in the last 100 years that all of these things have happened at the same time. That was just before the stock market crash in 1929, 1930, and during that crashing process. In the early 1970s, when the stock market didn't crash in one big go, it rolled over in 3 separate drawdowns that eventually ended up in the mid-1970s with a drop of 50% or thereabouts for the S&P. And then in the early 2000s, and we know that the stock market fell, the S&P fell 50% in 2000, 2001, and then it fell another 50%, having recovered, I should say, fell another 50% again in 2008. So in this event, there were 2 drawdowns in the stock market. So we had 1 drawdown, 3 drawdowns, 2 drawdowns. So the way the stock market suffers has varied on each occasion, but the net result is that the stock market has spent 10 to 15 years going effectively sideways. Yes, it went up, then it went down, then it went up again, then it went down. So effectively, in all 3 previous examples, the stock market just really went nowhere for multiple years. And that is the period of time that precious metals, gold, silver, commodities like uranium and like copper and base metals, and eventually soft commodities, energy and oil, that's when they all have their big bull market moves. It takes place during the gold bull era, which should now be stretching ahead of us for the next, I would say, sort of 7 to 10 years, stretching through until the early to mid 1930s, 2030s. And in terms of gold itself, I mean, it's important just to look at the big picture here. This is going all the way back to, well, 100 years. So it's 100 years of data. And for a large part of the early part of this chart, the gold price was pegged. The peg was removed in the early 1970s, and gold accelerated upwards in its big bull era. So it's important to look at silver during that period because gold had been pegged. If we examine silver through the same time period, you can see that silver, in fact, throughout the 1930s and 40s and 50s was appreciating in price. So we had a silver bull era already underway, and the late 1960s saw a drawdown on the price of silver and then a rapid 300% plus upside move out of this cup. Well, we've just seen the same thing, a rapid 300% plus upside move out of this cup. So in terms of comparisons to the 1970s, we are there or thereabouts for the initial upward surge for silver. So somewhere, I would say, between, we're approaching $90 now, and somewhere between here and about $120, $125, which is where there's a Fibonacci extension level. Somewhere in this zone, so the next sort of $30 or so, is where you'd expect silver to turn around and suffer some kind of drawdown correction. We don't know how deep or how long precisely, but then later this year, it's likely, if we're following the 1960s, 1970s type scenario, it's likely that the stock market would then start to decline either at the same time or quite possibly at a slightly later stage a few months later. So the stock market may continue to do well for a few months this year after gold and silver put in their tops. But long term, don't let me put you off here. You know, when I'm talking about tops, I'm just talking about interim, short term tops that, yes, we could see significant drawdowns for the precious metals. But the point here is, Jesse, that even if we have a huge drawdown now for gold and silver, and say gold comes all the way back down to $3,000, it's now in the context of an ongoing bull era that, for my money at least, sees the target somewhere up near $16,000, possibly higher. Timing wise, I would suspect the early to mid 2030s. And looking, if this parallel channel actually turns out to have any validity, then it would be perhaps even above $20,000. But my sort of estimation at the moment is somewhere perhaps around $16,000, and that target would be adjusted as the bull era develops. As far as silver goes, then the target for silver is quite reasonable, I think, to expect somewhere of the order $300. And again, that target for the early to mid 2030s would be adjusted and amended as new evidence comes in. So some really strong evidence there. I did mention copper. Do you want me to mention copper?
Yeah, please.
Okay, well, copper, just for those who might feel that they sort of have missed out a bit on the silver move, you can see how copper behaves very, very similarly to silver. We've got silver on the top here and copper on the bottom, and you can see the chart breakouts, the chart patterns, the bull market moves and the bear market moves mirror each other very closely. And we saw a breakout from this rising wedge pattern for silver back in sort of Q3, Q4 of last year. And when you get an upside breakout from a sort of a rising wedge pattern, they can be very energetic, as we've seen for silver, and quite violent, and they can overshoot their classical measured move targets. The classical measured move target would have been perhaps somewhere around $70 or even sort of the low 70s, and we're extending beyond that now. And so this is all a bit of a bonus for those of us who are riding the trend. But copper, look, it's just breaking out. It's just starting to break out now. And there are a lot of plays in the copper sector, copper miners, copper mining ETFs, copper funds that are just breaking out on their price charts a little bit like this and have the potential to move quite a long way in quite a short period of time, as long as the markets continue to hold up. And if you do a ratio chart of copper versus silver or copper versus gold, you'll notice that it's just breaking out there as well. In fact, not breaking out, but it's actually just reached an extreme peak. So silver has reached an extreme peak versus copper, historically speaking. I can actually do that chart for you if you want.
Yeah.
This is copper, and if I just put a slash on here, and then if I put XAG USD, what we're going to get is the copper versus silver ratio chart. And I'll just get rid of this top chart now. So this is copper versus silver, and I'm just going to get rid of some of the bits that we don't need. Let me just hide that. So when the chart's going up, it means that copper is outperforming silver, and when the chart is going down, it means that silver is outperforming copper. So you can see this chart has just dumped massively as silver has hugely outperformed copper. But bearing in mind that the copper chart is just breaking out now, and that this chart is reaching a potential support line there, or I should say a likely support line, then it seems to me that on the balance of probability, that this chart is going to reverse. And for it to reverse, for the chart to move up, we have to see copper outperforming silver. So whether, the ratio chart doesn't tell you whether prices are going up or down. It just tells you which is outperforming. The price of copper and silver could be going down, that could be going up. This ratio chart just tells you which is outperforming. So if you want to get an early heads up for copper moving into a period of outperformance versus silver that will add confidence to your trades in copper, just look for this ratio chart to start turning around and moving to the upside. It seems a perfect opportunity now for copper to go on a good run versus silver, which would support the prices of, or would support the continued bullish breakouts for the copper miners.
Great analysis. I'll turn to you, Patrick, now. I want to jump into uranium in a second, but I do want to discuss the broad market for just a moment. Kevin, you mentioned a few times that you think it could be headed in a downward direction. At some point, you said perhaps a few months of continued upside potential, and then after that, we could see a correction. Now, depending on who you talk to, some people will say we've been in a bull market since the 90s for the broad market. Some would say maybe post GFC, depending on what metrics you're looking at. And there's obviously a lot of different ways of looking at the chart, inflation adjusted or not. But it's interesting because I'm trying to put myself on the other side because I'm very focused on the commodity sector, and I tend to think all these tech stocks are extraordinarily overvalued. I would never invest in the S&P 500 index. I would never invest in Nvidia, Microsoft, all of these stocks. So I've started to watch YouTube channels that actually do those things and do recommend doing those things, just to try to put myself in the shoes of people who are participating in this move in the broad market. And it feels like it's such a weird feeling. It's like I can't wrap my head around their mindset here. Am I crazy? Because obviously the market can remain irrational longer than we can all remain solvent. But are we due for a large correction here in your view? How big of a correction could it be if so?
All right. Okay. Well, charts talk louder than my voice. Is that possible? I don't know. But let's start with the big picture stuff, okay? Then I could zoom in and add people granularity so we don't become some of these doom callers who are always calling a downfall for the stock market. So we can zoom in on the smaller time frames. But here's a big time frame chart. This is the SPX going up over 100 years. The moving average here I have is the 300-month moving average, super, super, super long term. And I kind of use that one because I fine-tuned it. Well, it's a nice round number there, but it just happens that a couple of tests here. Here was the bounce that led to the takeoff in 1949 after post-CRE. So when the capital rotation event was done and in favor of gold and was a new one in favor of the stock market, that thing rocketed upwards. After that, well, here I could show you the bottom. The bottom pane, guys, is gold versus SPX. And well, of course, gold was pegged here, but when this turns upwards, this is a capital rotation event where gold outperforms stock market. Here in the late 60s, gold starting to turn up, going to bull market versus a stock market. And when that happens, it's not good. Often close to that, you'll start seeing like this here, drawdowns in the stock market. It recovers, maybe a nominal new high, but after that, bam, it gets rug pulled again. And then it just goes sideways for many, many, many years. Here we had the retest of that long-term moving average in 1974, bounce off. Stock market did not do worse. It went sideways. And then after that started going up. And then this ratio versus gold goes down as the stock market outperformed gold. Look at that. Oh, the dot-com bubble. Stock market start having a big correction. Gold breaks out, goes up in a new uptrend, a bull market versus stock market. So double whammy. Dot-com bubble did not come in retouched here. But look at the GFC 2009. Now we have 3 reactions on this very, very long-term moving average. So it's kind of telling me that's pretty much a trajectory so far that we should expect, unless there's a re-acceleration in the stock market and it's different this time, that eventually, I don't know when, I put these little lines here. I don't know where the SPX is today there. That was at, in August, it was at 6,400. What's the SPX today? We're not at 6,400. It's at, let me check this for you guys. SPX is at, 6,900, but it doesn't matter here. So this is starting to break out here, or it has broken out. So gold is somewhere here. It's starting to turn up. It's moving upwards, higher lows, higher highs versus SPX. And that's not a good sign for the stock market. So it's a question of time now for the stock market to start having, whether it's subdued, smaller drawdowns, but just going sideways for a decade. And if it starts going sideways for a decade there, then you could extrapolate there how that longer term moving average is going to go up. This could be the roadmap. A logical roadmap for the stock market would be just going sideways, and then maybe in 2036 retag that longer term moving average. What level is that going to be? 4,000, 5,000? Like it's still going to be, it won't be devastating, because you got to remember, whatever's fueling gold and silver, that destruction of purchasing power will also help the SPX because it's priced in fiat. So it's going to help keep a floor under the destruction of purchasing power really helps put a floor under anything that's priced in US dollars. So that's pretty much a roadmap. So before that happens, guys, before we start being a doom guys, this is the chart. So here is my monthly chart. Nothing wrong here. I have here the distance from moving average here, showed a little bit of weakness here, recovered until, the price is not able to outpace that longer term 36-month moving average faster and faster. There's not really, there's no look at that thing there. I'm just going to zoom in there. There's nothing to worry about at all here. Even here on the monthly chart, maybe there's this going to be morphing into existence. There's nothing. Look, until you close below that 12-month moving average, I don't see why anybody should, be bearish on the stock market. I could zoom in on the weekly. There is a bit of slowdown here. Let me show you here. The distance from moving average is resetting here. So the stock market is not accelerating fast enough to outpace that moving average. So that's kind of showing you a little bit of weakness, but the price has not yet fallen apart there. There's nothing here. What about the daily, guys? Yeah, nothing here on daily. There's actually, you could even say there's some people say there's breakouts. I think there's actually there's breakouts here happening there. So it's moving upwards right now. There's no signs of any type of weakness. So you just got to wait. If you think this is going to roll over, then we're going to see it in the charts, on the daily charts. It will start falling apart. Here, I have this rising support line. There's nothing, everything's breaking to the upside right now. So there's nothing, nothing abnormal for the stock market. Gold's going up, but the only thing abnormal for the stock market right now is it's not able to outperform gold. It's not able to outperform silver, and that's not good. You see that at market tops, not bottoms, right? If for gold, for the stock market to enter a new secular bull era, like another 10-year, 20-year stretch of total like bonkerness, it would have to, those charts, that gold versus SPX chart, should be breaking down in favor of the SPX, and that's the opposite happening. So tick tock.
I like that word there, bonkerness. That's a new one on me.
I love it. Kevin, would you like to perhaps shed some light on the uranium market, the metal itself, and the equities, where you both see it positioned, and if there's still a value proposition to be had there? Because the equities have moved quite a lot. We've been arguably in a bull market since 2020, probably. Maybe a little bit earlier is when the genesis of this particular bull market began. Do we still have legs here to keep going for several more years in your view, or are we reaching a top potentially?
Yeah, sure.
Jesse, is that for you the answer, or for your viewers?
Well, yeah, right. For both of us. I mean, I always ask questions I want to know. But if you're coming at me with doom and gloom about the uranium sector, feel free. Then I'll know it's time to sell.
No, there's no doom and gloom there.
No.
To be honest, the uranium sector, along with energy, oil, base metals, precious metals, shows every sign of doing very well in the years ahead. This is the spot price of uranium, and back in 2020 or thereabouts, I put this chart out as I suspected we were developing a cup pattern, which is basically a geometric arc, which helps guide the price back to the point that it had previously been at when this cup pattern began to form. And I can't quite wrap my head around, I'll be honest, I can't necessarily wrap my head around exactly why price sometimes observes these cup patterns so sort of perfectly, but the market does what the market does. And I suppose that traders and algorithms are driving this, and they recognize when price is testing support lines, and the support line on a cup is just the same as a support line on one of these straight lines. But anyway, regardless of all of that, objectively, we are above the 3-year moving average, and we're above this technical indicator, which we keep referring to, the Ichimoku cloud, this green and red splodge. And long story short, when you're below that, you're in a bear market. It's on the left-hand side of the chart. And when you're above it, you're in a bull market environment. So despite the recent drawdown on spot price of uranium, we are still currently above both the long-term moving average and the Ichimoku cloud. Not only that, if I zoom in onto the weekly time frame and just pop it onto the line chart, you can see that we're breaking out of an inverse head and shouldery. That's another new word for you there, shouldery, inverse head and shouldery pattern. And I mean, these patterns aren't always textbook perfect. They don't always fit precisely with the parameters of head and shoulders or inverse head and shoulders, but very often you can observe, when you've been looking at these charts long enough, as I have, you can observe these sort of 1, 2, 3 type patterns, and they are, broadly speaking, when you can identify them, either a good chance of a bottoming pattern or a good chance of a topping pattern if it's the other way around. So there's a very good probability that the spot price of uranium continues to break out, but we'll just confirm that when we get the monthly close. Now, if we look at URA, which is one of the ETFs, you can choose any ETF you like because they all track each other. I use URA because it's got data going back a reasonable amount of time. There goes back to before the last sort of bear market. It sort of captures the last bear market in its sort of entirety there. But we saw the bottoming process taking place again around about 2020 with this false rapid sort of breakdown and then rapid reversal. So we then saw a very bullish move that got a lot of eyes on the uranium sector, followed by a very tedious, long consolidation. We've broken out from that, and we are just progressing slowly upwards, or not always slowly, actually, sometimes quite quickly, through these targets one by one. And the next target area really is going to be anywhere between about, I suppose, roughly 100, 110 sort of dollars or so on the URA ETF. But that wouldn't be the end of it, because from where we are now to here, I suspect it's just an interim target. I think it's very likely, given how long we estimate that the commodities bull era is going to continue, then I suspect that we will get another pause, perhaps around the top right-hand corner of this pattern, and then another acceleration after that, which is likely to be very sort of exciting. And that will probably will almost certainly coincide with this chart breaking out to the upside. And I'll just get the chart nice and clear for you. This is the uranium miners versus gold chart. And question for you, Jesse, would you want to be invested in uranium miners if they're not outperforming gold? And the correct answer is
yes.
Okay, that's not the answer I would have given, but okay. Well, I mean, you want to be invested in uranium miners when it's not outperforming gold. That's fine. But I think for most people, you're making life hard for me. The correct answer should have been no, not really, because if anything is not outperforming gold, then you should just be invested in gold. We're in a gold bull era. Everything is to be priced in gold rather than US dollars now, because gold is outperforming US dollars. So forget about US dollars. Use gold as your pricing mechanism. So anything that you are invested in for the next 7 to 10 years, well, in fact, anything that you're ever invested in, really, but during a gold bull era in particular, you want to make sure that what you're invested in is outperforming gold. In a stocks bull era, you want to make sure that whatever you're invested in is outperforming the S&P. So,
because I guess just to interject for a moment, I guess from my perspective, if uranium equities are underperforming gold, I guess it would depend on the situation, but my mindset would be that because I'm a fundamentals guy, obviously, when it comes to uranium, I spend a lot of time looking into the sector, and the fundamentals in my mind are just unbelievable in terms of just demand dynamics alone. Forget about all the reactors being built and stuff. That's kind of just icing on the cake. So I would look at it as like, I expect this trend to change, which is why I answered yes.
Okay. I understand that. My only pushback on that would be that narrative has been the case since 2021, but since 2021, uranium has slowly drifted, or uranium miners have slowly drifted down versus gold. So despite your narrative being no doubt correct, it hasn't helped you to get better returns than gold. And we know that silver has outperformed gold. The gold silver ratio broke down. So one of the things that we would have recommended, and in fact did recommend for our members, is to go all in on silver on that breakdown. So our gold silver ratio tracker on our website shows up a 100% position in silver if you're forced to choose between gold and silver. So it works the same with uranium. You know, your narrative is good, but until it breaks out through this area I've indicated on the chart, then it's not giving you any returns for your story. Your story will give brilliant returns as soon as we break through this level here, and at that point you're unleashing a move that is highly likely to replicate the move down here. So from a technical chart point of view, that is when you definitely want to be positioned in the uranium miners, and you'll have a few months to do it because it's not all going to happen in the space of a few weeks. So
Cameco might have done much better than URA though versus gold, right?
Cameco versus gold has done better. So if you pick
certain individual miners, and Energy Fuels has done absolutely fantastic. Yeah,
absolutely,
up 1,000% in 5 years or something like that. So yeah,
absolutely. If you bring up the chart for CCJ or CCO, whichever one you want, Canadian or US, but that's Cameco, which is, if I'll just get rid of all the drawings for a moment, that's Cameco, which has done incredibly well and is now at new highs. And of course, if you do Cameco versus gold, CCJ versus XAU USD, you can get the clear indication that Cameco has been outperforming gold since. I'll just get rid of all of the labels and diagrams and bits.
A 50% discount, Kevin. We can't honor that.
Tell us more.
It shows when I last looked at this ratio chart, but look, that is a very very interesting ratio chart, because Cameco against gold is hitting a important resistance line there, and if it breaks out, or when it breaks out above that resistance line, then you're going to get a high probability of a jump to the upside. Of course, if it doesn't break through that line, then the opposite is the case, and you've got high probability of the price chart moving down. So that's what technical analysis brings to the game here. Technical analysis tells you when you are at these decision points, and you can act on them, because as soon as we cross that line, then you have a high probability of a significant upside move. And until you do, you're kind of trapped for the time being. So, it doesn't really matter Cameco or gold right now. It doesn't matter too much until you break through that line. So, that, as I say, that's what technical analysis tells you. It tells you which of two assets is outperforming. You can look at the uranium miners versus gold and silver miners as well. And that's what this chart is. It's the URA chart versus ASA, which is a gold and silver mining index with loads of price history that GDX tracks precisely. And you can see the chart's been going down. So the uranium miners as a whole have been very significantly underperforming the gold and silver miners. But this is what we've seen. What I'm trying to say, I think, is that what we've seen so far is the first phase of the uranium bull era. And it was very exciting. And some of the uranium miners, the big companies that attract the investment money from investment funds like Cameco, they've done extremely well. But on the next phase, when this breaks out to the upside, you're going to see a whole host of smaller companies, the ones that haven't really moved so far, companies like, I don't know, Anfield Energy, for example, and I could reel off a whole long list of the uranium miners that haven't really done very much so far.
Blue Sky.
Blue Sky is another one. Yeah. Yeah, that's a perennial.
Is that one good? Fundamentally, Blue Sky, because it's a penny stock, right? Blue Sky.
Yeah, I'm aware of Blue Sky, but I'm a little more conservative than a lot of the uranium crowd on Twitter, in that I don't really mess with anything under like
Ah,
500 million market cap when it comes to
yeah.
uranium space. So I haven't even looked into it.
No, well, Blue
No,
Sky has a lot of work to do to even get to its breakout line. You know,
Yikes.
from you could have got into Blue Sky back here or back here, thinking, oh look, you know, it's going up, and if you weren't aware of where the resistance line was, you would have been
Yeah,
getting in just before the price fell by sort of 50, 60, 70%. So yeah, you need to look for companies that are um, above those breakout lines. I mean,
much better.
that one's a lot better. That's called deep yellow, that one, and it's looking great. I mean, it's got a rising wedge pattern. If it happens to break upwards from this rising wedge pattern, then that's going to do what silver just did, probably, because this is the exact chart pattern that silver broke out of. So an upside breakout from a rising wedge would be sending a signal that, you know, this company is likely to appreciate in price very rapidly, probably up to this sort of resistance area up here. So you could easily see the price double or triple in the space of a few short months. Of course, if it gets rejected at that resistance line, it doesn't break out, then the opposite is the case, and it would play out as a bearish rising wedge.
Or
You don't
or
want that.
a breakout to the upside, Kevin, and then it falls apart.
Exactly. There's a
But we're covering all angles. You
there's a
can't, you're a
whole
politician, Patrick. You can't do that.
whole range of possibilities here, and
Right.
you have to be fully aware of where the support and resistance levels are. You know, buying the monthly breakout is the safer way to do it. And
Yes.
once you get above the red line there, the upper red line on the monthly breakout, you then apply your stop loss. And fortunately, there's a nice little swing low there, so perfect place for a stop loss. You just put your long position tool on there, take your entry, put your stop loss just underneath this swing low here. Okay, so that's the swing low, stop loss just underneath it. Profit limit, well, somewhere around about $5, $6 is going to easily give you a 3 or 4 to 1 reward to risk. And you're just in this
Yes.
resistance zone on the left-hand side of the chart there. Don't be too greedy. Take your trade, take your profit, take your gains, and then roll it into your next trade. If you're wanting long-term positions, then this isn't a financial advice, this is just general guidance, which makes common sense. If you're wanting long-term positions, do so in mega cap stocks that have lower risk of the company going bankrupt overnight. Do it in funds or ETFs that roll together a large number of stocks, so you're exposed to a wider variety of the stocks. I know ETFs have disadvantages as well as advantages, but for many investors, they make it all a lot less confusing, rather than having to go through a great big long list of mining companies like this, trying to figure out which are the good ones and which are the bad ones.
Yeah, that is fantastic guidance. I completely agree with you there. Well, gentlemen, this has been a fantastic conversation as always. I feel like we could go on forever. I want to talk about oil and gas. I want to talk about agriculture. I want to go dive deeper on copper. So we'll definitely circle back and do it again. Thank you both so much for coming on the show. It's always a blast.
Thanks for having us, Jesse.
Yeah, thanks, Jesse. We didn't even mention Exxon. There's so much stuff to talk about. Stop it. Let's
Yeah,
continue.
well, but before I do let you guys go, though, tell us about NorthstarBadCharts.com, and I'll obviously put a link in the description below, but walk us through that service.
Yeah,
Sure.
sure.
Well,
Go on, Pat, go ahead.
yeah, well, North Star Bad Charts, guys, Twitter is Wild Wild West. On X, it's unnuanced, but on the website, it's all like these actionable charts. When's the breakout confirmed for Exxon? What's the target? What's the sell stop? Like, we cover it all. So it's behind a paywall, guys, but that's where you could get Kevin and I's attention and all the minute detail required there to navigate this properly.
And if you mention that you saw us here, then you never know, you might get a cheeky little discount of some sort.
Okay, mention VRIC Media when you do reach out. You guys also do like members only webinars as well, right?
We do, yeah. Part of being a member at North Star Bad Charts, we have quarterly Q&As for our members, and if you're a Premium Plus member, you get the master classes as well. We cover all markets. It's not just precious metals and commodities. We cover stock market, we cover currencies, we cover cryptocurrencies. You name it, it's all in there. We put the information there in front of the investors and traders, and they pick and choose what's relevant for them.
Great. Well, once again, link is in the description below. Thank you very much, guys.
Take care, man.